start out what's going on in the property market. This graph here shows, this is from our friends at RP Data CoreLogic, and it gives you an idea as to what the annual growth rate has been in the Australian property markets, the major Australian property markets, over the last 12 months. And you'll see, of course, that the markets are still growing. Yes, that growth has slowed down. And if we just highlight Sydney to start with, Sydney is still growing on a 12-month annualized basis up to the end of August, last month, at just under 10% per annum. In terms of its growth, that is. So yes, earlier on, it was closer to 15%. So the growth has just slowed down a little bit. This gives us an idea. This is the same information, but on a quarterly change basis. Again, from CoreLogic and up to date up to the end of August. And again, if we focus on Sydney, a lot of people have been talking about what has been going on in the property market during the COVID period. So over the last quarter, yes, we've seen a slight correction in the Sydney property market of about 2%. A lot of people expected a lot more than that. Australia-wide, the property market has held its own, holding its values across the nation. They're down about 1%, just over 1%. So if we can summarise all this in terms of what's going on in the property markets, just quickly at least, Sydney property markets fell by 0.5% last month. Dwelling values went down by 2.1% in the quarter, but they're still growing. The property market is still growing on an annualised basis. And I think the last statistic there from CoreLogic is quite an important one. And that is that we are just below the record high, the last high of the third quarter of 2017. So, you know, we have recovered quite a lot of that decline that we had in the last few decades. Interesting that the media's been having an absolute picnic on all this. And these are just some of the headlines of the beginning of the COVID period, where a lot of the economists and a lot of the media were talking about the market absolutely crashing. I mean, just look at some of these headlines. You've got, Sydney prices coming off 30, 40% by, what would normally be respected journalists and so forth, or economists. We certainly have not seen that happen, but the media did a fantastic job about getting the headlines. What more would you expect from the media? The last one down the bottom there, CBA expecting prices to drop 10, 20%. In fact, that went to as close as 30% as one stage. And the market back in March, when this first came out, really did respond to that, react to that. It went really quiet. The interesting point is this, and that is what the media is now reporting is exactly the opposite. Now, this just came out last week. You're getting the same economists. So the guys that made the headline statements back in March, CBA, Westpac, Reserve Bank, and so forth, those that were talking the market down very, very heavily, are now saying that the property market in Sydney and other states is going to increase in value over the next couple of years. Go figure. So they've gone from a decline, or predicting decline, to realising that the decline was never going to happen. COVID wasn't as bad on the property market as everyone expected it to be. And it just hasn't gone. And now we're looking at predictions of going up. So this is a very interesting slide as well, given to us by our friends at Blue Wealth Property, one of a market research company that we use to our investor clients. And what this tells us here is historically what has happened in the Australian property markets during economic downturns, and in particular after a crisis. So let's go over to the left-hand side of the screen, and you'll see here, firstly, Black Monday 1987, the property market. So if we just look at the dark blue line, the top line, which is the Sydney property market, and then the dot-com bubble of earlier this decade, back in 2000, and of course the GFC, the one that's probably the most recent of it. And you'll see in each case that the property market basically hibernated and stagnated. It did not crash. Yes, during the GFC, the property market, certainly in Sydney, went backwards about 3 or 5%. And you can see that decline in that graph during the GFC period. But what I'd really like to draw your attention to is this, and that is straight after each of these economic downturns, there was a significant upturn in property values in Sydney because confidence came back. Interest rates. What's been happening with interest rates? Well, look, we all know money's cheap at the moment. The Reserve Bank has been dropping its cash rate for quite some time now, and banks have been passing that on. And part of the reason why the market has been as active as what it has been over the last couple of years is because money is cheap. We're seeing record interest rates, record low interest rates. But a couple of things I'd like to draw your attention to here, and that is this, and that is the bottom line being the Reserve Bank cash rate. You can see that it's 0.25% at the moment. It's never been lower. The Reserve Bank has come out and actually said that it is quite happy with where interest rates are. In fact, it sees interest rates being at these record levels for quite some time, 2 or 3 years even. But what I'd really like to draw your attention to is the gap between the Reserve Bank cash rate, the light blue line being the standard variable rate, the light blue line being the 3-year fixed rate, and the orangey line being the variable rate. And what I'd really like to draw your attention to, if you go back, and that is, you'll see that the fixed rates, the gap between fixed rates and variable rates has gradually been widening. And you'll see that in a moment, that how wide that actually is at the moment. So fixed rates, variable rates have not been dropping as much as fixed rates in comparison to the cash rate. So there's a bit of a story behind that. So if I can just sort of give you a bit of an overall summary as to where the markets are in terms of property and so forth. Just 2 ticks. So what we've seen is this, and that is up to last year, and certainly in the second half of last year, in Sydney we saw that previous graph, that one of those first graphs I should say, that showed that city property values were increasing by around 15% per annum. Why was that? Pent-up demand, money being cheap, confidence, income being strong, employment being strong, people had a willingness to go out there and buy property. First-time buyers really came back. And we saw property values increase by 15% per annum right up to about the March quarter. So certainly the first quarter of this year. But then of course we had the COVID period and the coronavirus really take its hold February, March this year. And then you had the big predictions from the bank economists and other economists of the world, of Australia, I should say, saying that the market was going to correct itself 10, 20, 30%. I remember back then I was getting phone calls from real estate agents over a couple of weekends saying, what's going on? No one's turning up to open houses. No one's buying. Auctions are dead. Everyone just basically left the market. And it was largely a result of these expectations or these viewpoints from these economists that said the market was going to turn around 10, 20, 30%. Well, what the media didn't report was the factors behind all that. And all these predictions of 30% declines and so forth were based on the coronavirus and the COVID period having a very, very major effect. You've got to remember one important thing, and that is the banks were still lending 95% even during these periods. So they're lending 95% to first home buyers, and they were lending 90% interest only to investors. Do you honestly believe the banks would be lending 95% to first home buyers if they honestly believed the market was going to correct itself 10, 20, 30%? They would not be doing that. Clearly, the reason why the banks came out and made those predictions was because they didn't want to carry the can during the COVID period. They wanted the government to come in and step up as well. Hence, you've got JobKeeper, JobSeeker, you had all these incentives come in and other stimulus packages that the government introduced. And it worked. So what you've seen now is that the market has gradually came back. People are getting confidence back, and you're seeing auction clearance rates here in Sydney, around that 70% level. Auction volumes starting to get back up there again. People are now buying. And it's a very cautious market. Let me just say that, you know, vendors are cautious, buyers are cautious, but the market has definitely returned. There is no crash and there's no correction. You know, okay, the market's come back a couple of %, but really a couple of % in the scheme of things is not a huge amount. So what we're really seeing is the market at the moment going through a period of hibernation and stagnation, certainly no downfall, and the expectation is quite strong that the market will pick up. Look, you know, 2021, 2022, we don't know, but let's just see how that goes. But as confidence picks up and as people you know, realise that their income is still safe, their jobs are still safe, the market will come back. And just remember those graphs about the history of the economic downturns and what's happened historically. It's happening all over again.